when I say psychology, I'm not talking only about biases, like, because you explicitly, well, you make, when you say it's retail and not retail, you make a difference between retail and not retail. I mean, the government buyer is still a human. It's not an ovni. It still has a human brain, but it's not driven by the same biases. It still have biases, but different ones. It does think different. But it's still psychology, but different kind of psychology and different kind of strategy. So I would not say that. I mean, I don't think you can do any qualitative with zero understanding of how the human brain works. It just means that it's not the same part that are used. It's not the same models, as you said. That is, I agree with it. But I do think if you want to do into qualitative aspect, you do need some form of psychology one way or another. But it's not, when I say psychology, it goes way beyond than just like we usually understand by the word psychology. I'm thinking about, I try to look for an example to make it more with more clarity, is when you look at the competitive strategy, the competitive analysis, meaning like you look at the stakeholders of a company, you look at the employee, the suppliers, the clients, mostly, of course, and also the shareholders. Who are the shareholders? And you gotta ask all these people their motivation. Why do they invest it? Like, why do they work with them? Why do they buy this product? Why do they supply them? Why do they think this company is better than the other? And the opinion of all these guys. This qualitative investing requires a lot of psychology to be able to ask the right question to the right people. And that is why I consider that psychology is fundamental, even if you work with Palantir, a well-known B2B business that is working only with government and big corporation, that we might assume that there is not, of course, it's not at all the same logic as the analysis of Coca-Cola. It's not the same biases. It's not the same retail mindset, if I can say, but it's also psychology, just in way different forms. And that's something that I try to convey with my website, try to show that what are the right questions to ask and who are the right person to ask these questions. And this is a form of psychology, something that we are very used to do as entrepreneurs when we need to find our market fit, find the right, who we should sell to and what we should sell to them. This is this kind of a business psychology, if I can say. And that's why I wanted to connect the dot with what you were saying about your Chinese company that might not require these things at first. I don't know. I mean, you don't want to say the name. I guess we don't discuss the detail about this company because
it's not like it's secret. I just thought it would be a nice topic for a separate video, so that we don't just mix tiny pieces of different topics in one video.
Of course.
Absolutely. So we can do it, like, I don't know, next weekend and just talk about that one. But like the company I bought relies to a certain degree on population growth in the region. And especially the population growth of cities. And you can say you can say that you can trace that back to psychology. In other words, in cities you typically get a better job, better income, so people move from the countryside to the cities. So you can say, it's a psychological tendency to move from the countryside to a city. But in my view, that I would call that the power law that comes from statistics, or I think it might have a psychological explanation because it's about how humans behave. But I just would say it belongs to statistics, where you talk about how cities grow at a larger rate than the population in countryside, even though you can trace it back to psychology. So there's sort of, what sort of drawer you use for this, like what sort of group you call it. And another example is, when Charlie Munger talks about Disney and autocatalysis, where that's from chemistry, and he basically says, right, that Disney makes a wonderful cartoon for kids and releases that on in the cinema, and then the video cassettes come along and they take the same movie and put it on VHS. and then DVDs come along and they do the same, and then Blu-ray comes along, and then online streaming comes along. So that's auto-catalyzes, and you could still say that you can trace it back to psychology, because people want the same movie just in different formats. Because I bought a new laptop last week and it doesn't have a DVD drive, so I can't even watch those old Disney movies. I have to buy new ones on that stream online. So you can say this is psychological as well. It's just, I think it helps to sort it in different areas, so that you can have a nice overview over it. But it doesn't really matter which area it belongs to. It's just that you have the model, and it doesn't matter so much how you classify it. That's what I meant. But you're absolutely right that governments are obviously run by people, and they decide on different principles than buyers in a grocery market. My favorite case study is when the American government was buying the B-2 stealth bombers. They ordered like 100 pieces of them for I don't know, 2 trillion, and it was way too expensive, and they realized that, and they said, right, we are not going to buy 100 of them, but like 10. And the manufacturer said, well, okay, but the research cost is obviously the higher, the biggest cost of it all. So we're just going to divide that between the 10 pieces you're not buying. So essentially they bought 10 times less for 10 times higher price each. So they still got paid the same amount. They just received a much lower number of the aircraft. So you could say this is another psychological effect. It just was done by government, that and through a contractual means. It's not like it was decided by one person, right? These projects are decided by huge, large groups of people. And I think Warren Buffett was investing in General Dynamics as well. And he didn't do it because he liked research or whatever. It's just like General Dynamics was the only arms supplier who was willing to keep going with the American government as it contracted. So this is another very interesting area, how this psychology plays in these, I would say, technical or robust or almost impersonal areas where you are assigned to governments and not to individuals. So I don't understand this area very well myself, and I think it's very rare to find people who can predict the behavior of large governments. But I like to learn about it, even though I try to stay away from it because it's very difficult in my view. Yeah.
It's a different field, yes. Yeah. And every kind of company, I think we can sum it up by, as you said, there is different models. There are toolbox, and like a plumber, you use some tools on some constructions, and other construction, you need other tools. And that's all about having a toolbox with efficient tools, and you know how to use to apply them in the right context, and not be like the man with only a hammer who wants to bang everything because he doesn't have the other tools. So that's the beauty of Charlie Munger, if we can sum it up everything we said, is to have this huge toolbox of mental model to apply them in the right context and not be fit with only one or two models. That would be inappropriate in the context. I guess, did I summarize it correctly?
Yeah, definitely. Yeah, that's it. And I think that, another argument for this qualitative investment approach is that you have the best computer science graduates who are trying to outperform each other in writing scripts or just automated ways to trade stocks and other things. And if you are doing your investment decisions on numbers only, you're not going to defeat these people. It's impossible, because these robots are so much faster at everything you can possibly be. And I welcome this competition, because these robots are absolutely useless at qualitative factors, obviously, because you can't quantify them very easily, at least some of them. And this is what you want. I mean, when Charlie Munger says that today investors have it much tougher than they had it back then, 100 years ago or 80 years ago. Well, I think the investment landscape is different, but I wouldn't say it's so much harder, because what's different today is that you have huge amounts of people who are not even capable or interested in reading an annual report, that are playing against you in the stock market. And this is exactly what you want. You want huge masses of uneducated people who are behaving based on their emotional impulses. And these people are playing against you at the same poker table, so to speak. And this is what you want. And back then, I don't know if it was like that when Warren Buffett or Munger started, because investing was not so mainstream as it is today.
I think what he want, I'm not him, but I think what he want to say, but it's harder right now. It's just that when he started, he was in the aftermath of the Great Depression. So you could pick literally any decent stock with very little knowledge. You would make quite a lot of money. And this is different from today. If you pick a random stock today, the probability you're going to lose money is quite high, especially in a very, when the stock are overvalued in large quantity. Whereas back then, you can be like maybe 1 out of 2 chance to have a very decent profit. I think this is the difference. It means like right now, if you didn't read at least a couple of books on value investing or in qualitative investing or anything that is I mean, you have to get hard knowledge. You cannot pick a random stock and hope to make a profit. That is why the profit either will be little, or most probably you will lose the money on the next crash and the next bubble that will blow. So I think that's what I want to say on that aspect. Now, when it comes to the fact that back then, even say like nowadays nobody, not about like very few people read the annual reports, and back then it was the same. A few people reading these reports as well, but I guess that today to be competitive and make a profit, you have to learn more things back than that in the past. That's my interpretation of the difference of the context. And also we were not in the aftermath of a big depression, because in the 50s when they both started, it was like 20 years after the big depression, and the general mentality of people is like these guys who invest in stock, they're gonna lose their money because everyone lost their money. And it was like a whole culture, a whole like if you ask someone random in the street, would it be wise to invest in the stock market? Random guys will tell you, no, don't do that. You're going to lose everything. Look at 20 years ago, we lose everything. So of course you had less competition. And most importantly, the prices of the stock were rock bottom. So when you have even if you have you had company with very decent fundamentals, who are trading at PE 2 or 3. We know that PE is not enough to decide if it's a good company. But when all companies trade at PE 2 or 3, you just have to pick the decent one, and you're going to make a very, very decent profit. Nowadays, you have to think twice, because first off, nowadays, you don't have a lot of opportunity to buy at PE 2 or 3. The good companies, usually you have to buy them at fair value, not at undervalued. As Charlie Munger says, we don't want to buy an okay company at a fantastic price. We want to buy a fantastic company at an okay price. And that requires more skill than in the past. And I think that's what's different. We do have a lot of opportunities, because I would say, you talk about the retail investor, we are playing to the poker table. I agree with you. Modulo the fact that
no, not just retail. I mean, if you were employed as a portfolio manager at a fund, you would be looking at the next 3 months, and you would do a lot of stupid decisions because of your career.